let's talk about this theme that I have been speaking to investors about and that I've been noticing. And it's this idea of the kind of disappearance of public markets. We've been talking about these two tectonic changes that have been taking place in markets. The first, and very well understood, is the exponential growth of passive markets. Publicly, passive markets investing is now bigger than active investing all over the world, in particular in the US. In fact, this slide shows you how quickly that change has occurred and how now the passive industry in the US is bigger than the active space. In tandem with this huge shift has been the incredible growth of the private market industry and the disappearance of public companies from listed stock exchanges. A generation ago, public markets were the only place that companies would go to raise large amounts of capital for their businesses. A listing on a large public stock exchange like the ASX or the New York Stock Exchange gave you access to the largest and the most sophisticated pools of capital. As you can see here on the left, however, stocks, there were 8,000 companies on the New York Stock Exchange 30 years ago. In a 30-year period, during a time when the US has gone gangbusters, the amount of companies listed on the New York Stock Exchange has halved. At the same time, the number of firms owned by private equity has gone from around 2,000 to 11,000. And this shift is not hard to understand. I mean, regulation, litigation, relentless public scrutiny, and the fact that the passive industry will copy everything that you bring to a public market mean that raising money from public capital markets has got a lot less appealing. Today, there are vast pools of private equity capital willing to take these exciting companies private. Worse, new companies really come to public markets for their growth capital anymore. The typical life cycle of a company now is you raise your money from a venture capital fund. If it does really well, you sell yourself to a private equity fund. The private equity then takes and extracts all of the growth out over its life. And it's only at the end, when private equity doesn't really want the business anymore, that it becomes listed. And some of the best businesses are just never listed. You can see the second chart here that less than 15% of public markets in the US, the public markets of companies of any real size, are publicly available. The rest are in the private sector. And so, I think this idea that the public markets used to be this gateway between investors is sadly becoming less and less the case. New companies are listing in smaller numbers while existing companies are being taken private. To highlight this theme further, if we look at this chart, we can see the size difference. On an ACWI basis, less than 9,000 public companies available versus the equivalent 200,000 in the private space. And to me, what's more interesting is probably this slide, which shows the size of these markets, just shy of 90 trillion in the public space and 11 trillion in the private space. It's not hard to conclude that private equity is growing from a very low base and has a long way to run when you look at these graphs. Couple that with the fact, or adding to the tailwind, I guess, is the fact that private equity has generated considerably better returns than public markets have. Here on the screen in front of you in the blue is private markets, in the gray is public markets. And you can see over the 5, 10, 15, and 20-year time horizon, public markets have really been outdone by the private space. The only exception there is the 3-year. And these returns have been driven by the Magnificent Seven and how well they have done. And you could argue that public market investors have been very lucky that these large technology stocks have been available to them. The Mag 7, Amazon, Google, Nvidia, Facebook, they've generated most of the returns over the last decade or so, and they were listed 25 years ago. The question is, would they actually go public today? Yeah, I'm not sure they would. To highlight this, if we look at the current crop of high growth technology companies that are disrupting the world nowadays, very few of them are listed. This is the 5 largest private companies in the world. OpenAI is now valued at 800 billion. The combined value of these 5 companies alone is 1.8 trillion US dollars, which is bigger than all 200 of the companies listed on the ASX 200. Names like, for me, I think these sort of names are the NVIDIAs and Googles of our time, and all this value and growth has been created outside of the public domain. Now, it should be said, I'm not here to promote private equity or private credit or private debt. I couldn't care less whether we invest in the public markets or the private markets. As I said at the beginning, our strategy is to look for discounted asset plays around the world. Whether those give us access to the public markets or private markets is not really relevant. But what we do is we're able to invest across both, which really kind of highlights and gives diversification on another level. Just in terms of this theme and how it relates back to the Global Value Fund, it is worth pointing out, this is not a new theme to us. In the 11 years that we've been running the strategy, we've always had some exposure to the private markets in the region from 10 to 30% exposure over time to both private credit and private equity. And in fact, at the moment, we actually have exposure to both TikTok and SpaceX. TikTok is owned by ByteDance, and SpaceX through discounted asset plays. So we actually do have some exposure to those names, which is great. That is just a theme that I think has been interesting that I wanted to share with you guys.